Price charts. Now, we've been talking about all these different ways of displaying this information. The simplest way to display this information is what we call a line chart. This is Anglo's. I'm connecting the closing price every day, and there we go. You can see what Anglo's been happening. You've got two scales. You've got your Y. Okay, that's your price in cents, and then your X scale, your horizontal scale, that's the time. So I'll show you roughly about 2.5 years. This is until Friday's information. So that's what they call a line chart. Go one step further, you get what they call a bar chart. Same graph now, I've just zoomed into about 2 years. That gives you much more information. You'll get the high for the day, the low for the day, the tick to the left where the market opened, the tick to the right where the market closed. And obviously the fourth bit of information that comes out of the JSE every day is the number of shares traded, which is volume. So usually displayed at the bottom of the screen in the form of a histogram. Okay. So this is what a lot of novice traders will be using, bar charts and line charts. I use them myself. I switch between the two of them. As you get more involved in the market, you start using things called Japanese candlesticks, where the bar chart looks at the relationship between the close relative to the high-low range. A candlestick now starts looking at the relationship between the opening price and the closing price. If the opening price was lower than if the closing price was lower than the opening price, it would be what they call a folding candlestick, will be black, or in this situation of mine, will be red. If the closing price is higher than the opening price, it would be a bullish day, and it would be a blue day. Okay, so much more information, and obviously from that you can also pick up a lot of intraday chart patterns. They've got nice little names like dojis and shooting stars and spinning tops and things like that. Similar to the bar charts, in the sense that you'll also have little gaps. Japanese candlesticks we call gaps windows. With bar charts, you get things what they call breakaway gaps and exhaustion gaps and islands and key reversal days. These are all tools that you'll anticipate what's going to happen the next day. Okay, so that's how you display price information. And those are the 4 or 3 most important ones that most of us will be using. Okay, and from there we start overlaying it with things like moving averages. So moving averages, and what I use in this situation, I'm using a simple 50-day moving average and a 200-day. You can use whatever periods you want to use. I suggest use 2 moving averages. The idea is the crossovers, what's important. If you just have one single moving average, the disadvantage is that in a sideways market, you'll get what they call whipsaws or false signals. So what I like to use is a 50-day and a 200-day. In this situation, my red line, which is the 50-day, it hugs the share price closest. Obviously, the shorter the period, the closer to the graph. The longer the period, the furthest could be away from it. Now, the idea is when the 50-day crosses below my 200-day, that's what we call the golden cross, okay, or the death cross rather. So that gives me confirmation we're going from an uptrend to a downtrend. As long as the share price stays below those 2 moving averages, we're having a downtrend or a bear market. Okay, you can see it roughly about 4 or 5 months, and as the share price was down. Then we had a bit of a rally, okay, and when the share price 50-day crossed above the 200-day moving average again, that's where you're given what they call a golden cross. Anything above that will be good news. But you can also see that this didn't last very long. Just after that, we had another death cross again, and 3 months later, we had the buy signal again, the bullish signal. I use this to determine if shall I be long or shall I be short. That's from a trading equity point, derivative point of view. Okay, so the point I'm trying to make also, don't ever use technical analysis, one technical indicator by itself. You want to use various other technical indicators to confirm. So you might want to bring in moving averages, your trend lines and things like that. I like to use other technical oscillators. That brings on what we call, let me just bring it in here quickly. Okay, this is what they call MACD. Now, there are hundreds of different technical oscillators and technical indicators. Some work well in the trending market, some work well in the trading market. I like the MACD, which stands for Moving Average Convergence Divergence. There's 2 moving averages. If you look at the, bring my little cursor back in there again, my pen, my spotlight, there we go. It's the difference between a 25-day and a 12-day moving average. The difference between the two of them, so I subtract the 12-day from the 25-day, it creates a 3rd moving average, and I put a 4th moving average on top of it. That's a 9-day trigger. Okay, so the interpretation, and this is the reason why I like to use this indicator, because it works well in both markets. It works well in the trending market, and it works well in the trading market. But also it's very versatile. You can use it various ways. First of all, it highlights, for example, seriously overbought and oversold levels. At the very top here, that's very, very overbought. It hasn't been overbought for a long time. At this level here, it was very, very oversold. Okay. Remember, when the share price goes up, there's more buyers than sellers. So that's why we talk about overbought. When the share price falls, we talk about oversold, more sellers than buyers. Okay. So the best time to buy is obviously as close to the bottom of the cycle as possible. The best time to sell is at the top of the cycle. Okay. So there's various ways of using MACD. You can use a crossover when it crosses up through zero, going from oversold territory into overbought territory. And when it comes down through it again, that would sell. Okay, it's a bit more conservative. You see, you don't get so many buy and sell signals. Alternatively, you can use a crossover when the MACD crosses its trigger line, that little dotted line. That's where you'd buy, and that's where you'd sell. Okay, so there's various ways of using it. I like to use the crossover, the zero line, a bit more conservative. I'm going for the bigger move. Okay, well, even say this could have gone in a bit earlier. I'm not worried about it. I might miss the first 10%, and I might miss the top 10% here. I want to take advantage of the 80% in between. That's what this does for me. But even more powerful, going back to my previous slide, when I say in a sideways market, that was September, October last year. Remember the sideways market? Okay, that's what we were talking about. This is where this indicator is also powerful. It highlights what they call divergence. In this situation, is what you call bearish divergence. The share price is making new highs, but the indicator is doing the opposite. It's failing to confirm. It's telling you, watch out, the share will be changing direction. And lo and behold, that's what happened here. Okay, that's what they call bearish divergence. It's warning you. So remember, moving averages are what they call lagging indicators. MACD acts as an early warning or a leading indicator. Here's another example. Share price making new highs indicates failing to confirm that. What happened? We had another fall. Okay, so this is how you can start anticipating what's going to happen in the market. So those are bearish divergence. Here's an example of bullish divergence. Yes, slightly sideways market, but you can see what happens with the indicator. The indicator is doing the opposite. We're making slightly higher lows. Watch out, we'll be changing direction soon. So we're in from a sideways market, and lo and behold, we have this little rally. Okay, that's why I like MACD. And we should understand there are a lot of other indicators. I use RSI, stochastic. There are hundreds out there. Okay, so the idea is what's important is understand the interpretation. What does this indicator do? I like MACD because it works well in both markets, and it's got a lot more uses. Okay.